What really makes some stocks, take off while others just sit there?
Yeah.
It's the age-old question in finance, isn't it? What's actually driving stock returns?
It absolutely is. And
Yeah,
we often bump into these puzzles, these anomalies where stocks just don't behave the way our neat, rational models say they should,
exactly. Things that make you scratch your head.
for sure. And for a long time, the go-to explanation has been this idea, sometimes called the risk doctrine.
Okay, the risk doctrine.
Yeah, basically, if you see some company trait, like, say, being small or having a high book-to-market value, consistently linked with higher returns,
Right.
the assumption is, well, that trait must be a stand-in for some kind of underlying risk factor that investors are being paid to bear.
Right, like the classic FAMA and French work from the 90s. They pointed to size and value book to market and argued these weren't just quirks.
Exactly. They said SMB, the size factor, and HML, the value factor, were real risk factors, fitting into big theories like Merton's ITPM or Ross's APT.
Yeah.
They were fundamental risks.
That became pretty standard thinking.
It really did. But, research never stands still. In 97, Daniel and Titman threw a wrench in the works.
Oh, yeah. What did they find?
Well, they looked closely and argued maybe it's not the risk tied to those characteristics, but the characteristics themselves that are driving returns. They found stocks with similar traits tended to perform similarly, kind of regardless of their measured sensitivity to those French factors.
So, characteristics dominating covariances, that sounds like a direct challenge.
It was a huge debate starter.
Hmm.
And this whole idea of trying to tease apart risk versus, well, maybe mispricing using their test, it became a really key tool.
And this wasn't just theory, right? People applied this
Oh,
thinking.
definitely. You saw it pop up with the accrual anomaly. Sloan's work showing high accruals often mean lower future returns. Hirschleifer and others link that back to characteristics, and even looking globally, like Howe and his colleagues did.
So, the general vibe was if characteristics are winning, maybe the market's not perfectly rational.
That was often the interpretation, yeah. Barbers and Thaler pointed out, look, in a rational world, beta risk should be the driver. If
Hmm.
characteristics are doing the heavy lifting, it suggests something else is going on, maybe mispricing.
Even the accounting folks got into this distinction, right? Trying to figure out if a return pattern was risk or just something about the firm itself.
Absolutely. Richardson and others highlighted this need to differentiate. It was a big theme.
Okay, so that sets the stage. But now we're diving into this paper, The Investment Manifesto by Lin and Zhang. And they're basically saying, hold on, maybe we've been looking at this the wrong way.
That's exactly it. They come at it from a completely different angle, what they call the investment approach.
The investment approach, so moving away from the investor side.
Precisely. Instead of focusing purely on investor psychology or risk aversion, they look at the firm. What drives a company's own investment decisions?
Interesting. Shifting from demand to supply, in a sense, how does that work?
It's grounded in the basic logic of corporate investment. A firm invests until the expected benefit of that next project, that marginal Q, equals the cost. And interestingly, this is essentially the flip side of the WACC, the weighted average cost of capital approach from corporate finance.
Ah, the hurdle rate companies use for projects. Okay, I see the link.
Right. So WACC is the return a firm needs to make to satisfy its investors. The investment approach links this required return, this discount rate, directly to the firm's characteristics,
Mhm.
not necessarily to how its returns move with aggregate consumption risk, like in the consumption models.
Got it. So the company's own situation and choices become central.
Exactly. And from this perspective, Lin and Zhang raised two big challenges to that traditional risk doctrine we talked about.
Okay, let's hear challenge number one.
First, they question whether these factors built from characteristics, like size or value, are truly risk factors in the sense of representing fundamental economy-wide uncertainty.
Right. Because a real risk factor, based on someone like Brock's work, should be something hitting everyone, like a big productivity shock, shouldn't it?
Precisely. A firm's size or its book-to-market ratio, well, those are specific to the firm. They don't inherently represent some simultaneous shockwave across the whole economy.
So, what's the investment approach explanation for why these factors seem to work then?
Their view is that these characteristic-based factor models are probably just linear approximations of the actual returns on investment that firms are generating at the firm level.
So, HML isn't necessarily capturing a value risk premium, but maybe just reflecting that high book to market firms tend to have different investment return profiles.
That's the idea. They even point out that in their model's investment return equation, market to book shows up directly in the denominator, linking it clearly to value. Size, however, doesn't have that same direct theoretical link in their framework.
Suggesting maybe the size factor is less fundamental from this view.
Potentially, yeah. Maybe redundant if you properly account for investment returns.
Okay, that's a big shift in thinking. What's the second major challenge?
The second one tackles that Daniel and Titman finding head-on, the observation that characteristics often seem stronger than covariances in predicting returns.
The finding that usually gets chalked up to mispricing?
Exactly. The risk doctrine says if risk doesn't explain it, it must be irrationality. But Lin and Zhang argue the investment approach provides a perfectly rational reason for characteristics to predict returns. It comes back to that investment return equation and how it connects characteristics to expected returns, which they note has empirical backing too.
So, characteristics winning the horse race doesn't automatically mean the market's broken.
Not necessarily, no. They make a really crucial point about theoretical equivalence. In general equilibrium, the consumption-based models, focused on covariances, and the investment-based models, focused on characteristics, should actually yield the same expected returns. They're like two sides of the same coin, as the paper puts it.
Two sides of the same coin. How so?
Well, think about it. The consumption view says risk drives returns. The investment view says investment opportunities and costs linked to characteristics drive returns. In a balanced economy, these have to align. A firm facing great investment opportunities, high expected investment return, should also be perceived as having a higher required return by investors, high expected stock return.
Okay, they should theoretically match up. So why then do characteristics often seem to dominate in the empirical tests, like the Daniel-Titman test?
Now we get to the really crucial part. Measurement errors. Lin and Zhang argue that this apparent dominance of characteristics might have less to do with genuine mispricing and more to do with the fact that our measures of risk, those covariances, are just inherently noisy and imperfect.
The classic problem of messy real-world data versus clean theory. How do they show this?
They use a model, a simplified version of Zhang's 2005 model, to illustrate. It's a simulated economy where firms make investment decisions based on things like adjustment costs and productivity. Importantly, risk is real and time-varying in this model world.
And they run the Daniel-Titman test on data generated by this model.
Exactly. First, they replicate the test on real data, finding, just like Daniel and Titman, that book-to-market seems to dominate the HML factor loadings. No surprise there.
Okay.
But then, they run the same test on their simulated data. And guess what? They find pretty much the same thing. Book-to-market appears to dominate the HML loadings, even though the data comes from a world where risk is rationally priced.
Wait, so even when risk is known to be the driver in the model, the test still makes characteristics look more important.
That's the kicker.
Yeah.
And they take it a step further. In the simulation, they know the true conditional beta, the actual real-time risk measure, which we can never perfectly know in the real world.
Right, we can only estimate it.
So they rerun the test in the model, controlling for this true beta. And even then, book-to-market still retains significant predictive power.
Wow. That really suggests the test itself might be biased, doesn't it?
It strongly suggests that, yes, it implies that the way the test is set up might be inherently favoring characteristics, even in a rational world.
Why? What causes this bias in the test, according to their simulations?
They pinpoint two main reasons. First, there's a correlation issue. In their model, the true beta and the book-to-market characteristic are positively correlated. They both tend to move with the underlying economic conditions.
Okay.
So when the test statistically tries to isolate the effect of book-to-market after accounting for beta, it inadvertently removes some of the predictive power that book-to-market has simply because it's correlated with the true underlying risk. If they surgically remove only the part of book-to-market's predictive power directly linked to beta in the simulation, its independent predictive power vanishes.
Ah, so it's hard to disentangle them cleanly because they naturally move together. What's the second reason?
The second reason is the order of the sorting in the Daniel-Titman test. They first sort stocks into portfolios based on characteristics, like book-to-market, and then within those portfolios, they sort by the risk proxy, like HML loadings.
Right, a sequential sort.
Their simulations show this specific sequence tends to amplify the apparent importance of the characteristic used in the first sort. If you flip the order sort first by the risk proxy, then by the characteristic, the predictive power of the characteristic looks much weaker relative to the risk proxy.
And does that hold up in real data too? If you reverse the sort?
Yes, they show that reversing the sort order in the real-world data also significantly dampens the apparent dominance of characteristics.
Yeah.
It's a really powerful point about how the test methodology itself can influence the conclusion.
That's fascinating. So The test might be flawed, and we also have problems measuring risk accurately in the first place, right? What are the main issues there?
Absolutely. They hit on two big ones. First, time-varying betas. Real-world risk isn't static. It changes. But we often estimate betas using, say, the last 5 years of data in a rolling window. That gives you a backward-looking average beta.
Which might not reflect the risk right now.
Exactly. It's an unconditional estimate. Their simulations show that if you use these backward-looking betas instead of the true dynamic beta from the model, the measured predictive power of beta drops significantly. It just looks weaker than it really is.
Like driving using only the rear view mirror?
Kind of, yeah. The second issue is specification error in models trying to predict beta changes. Researchers try using current economic variables, interest rate spreads, etc., to estimate conditional betas.
Trying to be more forward-looking.
Right. But these models are usually linear, and the true relationship between those variables and beta is probably way more complex, nonlinear. Again, simulations show that even using these more sophisticated conditional beta estimates, beta's apparent power is still much weaker than its true power in the model.
So our tools for measuring risk are just blunt instruments in a way.
That seems to be the message. And this isn't just an academic curiosity. The paper notes that this difficulty in reliably measuring risk has led to, well, some disillusionment in the accounting literature about using these risk-based models to get precise cost of capital estimates for firms.
Yeah, I can see why. If your risk inputs are shaky, your output isn't going to be solid gold.
Exactly. They cite folks like Lundholm and Sloan and Penman who voiced these concerns quite strongly.
Okay, so the investment approach offers a compelling alternative view. But what about criticisms of the investment approach itself? Does the paper address those? Like, does it really explain the anomalies?
That's a common question. Critics might say, okay, link returns to characteristics, but why are those characteristics linked to returns? Lin and Zhang's response is essentially that the common factors you see in characteristic-sorted portfolios aren't some mystical risk factor. They likely just represent the shared dynamics of the underlying investment returns of those types of firms.
So the factor is just capturing shared investment realities.
Pretty much. And they argue it does address expected returns and therefore risk premiums across stocks by directly linking them to these observable characteristics via the firm's optimization problem.
What about the CIPM failures? Like value stocks often having low market betas, which seems counterintuitive if they have higher returns. Does their model explain that?
They acknowledge this is a tricky point. Their own model simulation, they admit, doesn't fully capture the very low market betas sometimes observed for high minus low anomaly portfolios in certain data periods.
So it's not a perfect match there.
Not yet, perhaps. They suggest avenues like incorporating rare disaster risks or other economic shocks might help bridge that gap in future work. But they stress this is more about the specific setup of the stochastic discount factor, the M in the model, rather than a flaw in the core investment return logic itself. That logic holds regardless of the specific M.
Got it. Another argument you sometimes hear is that fundamentally covariances must determine expected returns in equilibrium.
They push back on that a bit. They argue that strong causality from risk to return really holds more in simpler endowment economies where payouts are just given. In a production economy where firms actively choose investments, it's all simultaneous.
Ah, so it's not a one-way street.
Exactly. Risk, return, investment, characteristics, they're all determined together in equilibrium. You can't necessarily say one causes the other in a simple linear way.
Okay. And the big one, rationality. Does the investment approach mean anomalies aren't due to investors being irrational?
It offers a rational framework, which is different from proving rationality. It shows how firms, acting optimally based on their cost of capital and investment opportunities, would lead to relationships between characteristics and returns. That cost of capital could be low for various reasons, maybe rational ones, maybe behavioral ones affecting investor demand, but the firm's response can still be rational.
So it provides a mechanism other than just blaming investor mistakes.
Right. It gives a supply-side, firm behavior story that can explain these patterns, offering an alternative to purely behavioral stories.
Yeah.
It doesn't rule out irrationality, but it shows it's not the only possible explanation.
And finally, what about the test of the theory? Is checking if investment return equals stock return a weak test?
They tackle that too. They say, look, the ex-ante equality expected investment return equals expected stock return isn't just some side effect. It's a fundamental equilibrium condition from the firm's first-order condition.
Okay.
And ex post, the realized investment return, actually helps explain things we observe, like returns around earnings announcements. They acknowledge that forecasting stock returns precisely using expected investment returns is hard because of measurement issues.
The same issues we discussed with risk.
Exactly. But they highlight that using the components of expected investment return, things like investment to capital ratios and profitability measures, which Hu, Zhu, and Zhang did in later work, has actually been quite successful in predicting cross-sectional returns.
So the pieces of the puzzle work, even if putting the whole expected return forecast together perfectly is tough.
That's a good way to put it.
Okay, let's wrap this up. What are the absolute key takeaways from this investment manifesto deep dive?
I think there are a few big ones. First, it's a serious challenge to the traditional risk doctrine view that characteristics must proxy for risk.
Okay.
Second, it suggests that the apparent dominance of characteristics over measured risk in empirical tests might be significantly driven by measurement errors in our risk proxies and potential biases in the tests themselves, not necessarily just mispricing.
Right, the measurement issue is huge.
Huge. Third, the investment approach provides a theoretically sound, complementary perspective to the consumption-based view. It links expected returns directly to observable firm characteristics through the lens of optimal corporate investment.
A rational, firm-focused alternative.
Exactly. It gives us a way to think about anomalies rationally, focusing on company actions, without immediately jumping to investor irrationality as the sole explanation.
It definitely makes you think differently about what might be going on under the hood of the market. Not just abstract risk, but concrete company decisions.
Absolutely. And that leaves us with a question for you, the listener, to ponder. If firm investment decisions are this central, how should that change how we look at companies? Should we be digging deeper into capital allocation, profitability trends, investment efficiency? Are those the real clues?
Yeah, should our focus shift more towards the company's operational reality? It's definitely something to chew on. How does this investment lens change how you interpret financial news or analyze a stock?
Worth considering. And if you want to go deeper, the Lin and Zhang paper itself is definitely the place to start.
Great point. Well, this has been fascinating. Thanks for walking us through it.
My pleasure. Lots to think about.
Indeed. Thanks, everyone, for tuning in to this deep dive.